One of the biggest mistakes I see new traders make all the time is refusing to trade with the trend. By ignoring this fundamental principle, they are missing out on some of the best trades the market has to offer. If we instead trade in the same direction as the trend, capitalizing on the imbalance between supply and demand, we can get both more trading opportunities, but we can also achieve a higher win rate. In today's video, guys, I will show you guys a 15-minute day trading strategy, as well as a set of rules here that you need to follow every single time you perform this strategy to achieve as high win rate as possible. So make sure, guys, to follow every single rule in this video, and I don't want to waste your time, so without further ado, let's just get started right away here. Alright, so what I need you guys to do here is to open up a naked chart, meaning that we have no indicators, no support or resistance levels or anything like that. Right now, as I'm speaking, I'm looking on the USD JPY 15-minute time frame, and especially for beginners, I really recommend the 15-minute time frame, because compared to, for example, the 5-minute or the 1-minute time frame, the 15-minute time frame gives you more time to both plan and think about your trades. But if you are a more advanced trader, you can use this one on the 5-minute and the 1-minute time frame as well. The very first rule we need to understand for this trading strategy is something called the Dow theory trend. And you may of course wonder, what is that? Well, in order to have a Dow theory uptrend, what we need to see is that we need to see both consecutive higher highs, right? So you can see we have one high, higher high, higher high, but at the same time, the trend needs to print consecutive higher lows. So in order to have an uptrend, we need to have higher highs and higher lows. The same thing, but the opposite is true for the downtrend. We need to print consecutive lower highs while at the same time printing consecutive lower lows. So let's go back here to the chart. The first step for this trading strategy is that we need to identify either a Dow theory uptrend or a Dow theory downtrend. And let's take a look at this 15-minute chart right here. We can see that we have one low right here, we have a high right here, right? And then you can see that this low was just slightly higher than the previous low, but we still have a higher low, right? Then we have yet another higher high. You could argue that this is another low. Then we have another high. We have a higher low, higher high, higher low, higher high, higher low. So as you can see, in this case, we have a pretty clear Dow theory uptrend. We are printing consecutive, both higher highs and higher lows. The second rule here for this trading strategy is called tools for confirmation. So what we want to do here is that, yes, we have already identified an uptrend, but we need some tools for confirmation where we should enter the trades. And one such tool we can use, let's go up here to the indicators tab and let's search for EMA, which basically stands for exponential moving average. So we want to open up the moving average exponential indicator right here, and as you can see, a blue line appeared on the chart. The next thing we want to do here is that we want to go up to the settings tab of the moving average, and we do want to change the length of the moving average here. And in my opinion, a solid rule of thumb is to change the exponential moving average to 50 periods. And we also want to change the source here from close to where it says OHLC. This will make the moving average base its calculations on the open, high, low and close. So we change to OLHC. What is very important to understand about the moving average, and what we talked about in my video about moving averages that I highly recommend all you guys to check out, is that there is nothing magic about the 50-day moving average. For example, we could as well use 53-day moving average, or we could use a 48-day moving average. The length of the moving average will depend a bit on a case-by-case basis, depending on how many bars we are currently looking at on the chart. You can see right now we do look at around 150 bars. And for this strategy, a good rule of thumb is to take this number and divide it by 3. So around a 50-day moving average. Yet another tool for confirmation I do want to use here is that I do want to go up to the indicators tab once again, and I do want to open up the RSI, or in other words, the relative strength index. And as you guys already know, if you have been watching my video about the RSI indicator, which I also highly recommend you guys to check out after this video, I go really in depth about the RSI and various different ways how to use it. If you have been watching this video, you know that most of the times when we use the RSI indicator, we don't really care about the yellow line right here, which is basically a moving average of the RSI. But in this trading strategy, I find that the moving average of the RSI can be a good tool for confirmation of the uptrend. So two signals that can help you confirm a good uptrend for this trading strategy is that first of all, we want to be taking trades that are above the moving average, so you can see above the moving average right here. But what we also want to see is that we want to take trades where the RSI, the moving average of the RSI, is above the 50% line, and the 50% line is right here. What we can do here is that we can actually go to the settings of the RSI, we go to the style tab, and we can uncheck the RSI upper band, the RSI lower band, and we can also uncheck the RSI background fill here, and we can also actually make the middle band here a bit more clear. So we can make it, for example, white, and we can make the line a bit more thick here, and then we press OK. So now we can clearly see when the moving average is above the 50% line. The next rule for this trading strategy is how to identify precise entry points here. And for the entry points here, we want to use our rectangle tool to draw support and resistance levels. And what we want to do for this trading strategy is that we want to take a look at the highs, and we want the price to break the high and go down to test that previous level. So as you can see right here, we use our rectangle tool, we take a look at this high right here. We can see that this one was, you know, the previous high. And what we want to do here, what we want to see for this trading strategy is that we want the price to break the high and go down and test this previous resistance as support. So in this case, we had a high, the price went above, and we tested this one actually as support 2 times. We take a look at the next high right here. Once again, use our rectangle tool. You can see in this case, we had yet another high that flipped to become support. You can see we had a high right here. We broke that one, flipped it to become support, and we can also see that we had yet another high right here. And remember guys, we only want to take our trade in an established uptrend, so it's important that the price is above the moving average, and we also want to see the RSI here trading above the 50% line. So if we have the price above the moving average and the RSI above the 50% line, then we are looking out for our entry points. In order to confirm the exact entry, I want to use yet another tool, and that is that I want to use candlestick patterns. I want to see some kind of bullish candlestick pattern, such as a engulfing pattern or a strong momentum candle to signal the entry for the trade. And as you can see, in this case, we actually had a bullish engulfing pattern. You can see this green candle together with the red candle. So here we want to enter the long position at the candle close of this engulfing pattern. As for our stop loss, you may of course wonder, where do we set our stop loss? Well, the stop loss we want to set below the lowest part of the pattern. So what I usually like to do here is to set the stop loss below the lowest point. You can see the lowest point right here, so we set the stop loss below. What you also can do if you want to be a bit conservative is that you can set the stop loss below the support area. So you have basically 2 options here, either just below the candle or below the stop area. But let's be a bit, let's set a tight stop loss. Then this would give us a stop loss at around this point right here. And as for the profit target, you may wonder, where do we set our profit? I recommend to keep it simple, guys. Keep it very simple with a risk to reward ratio of 2. You can see right now our risk to reward ratio is 2, and we're looking for a quick and easy day trade here. And as you can see in this example, we got a relatively nice trade, and we can see that our 2-to-1 risk to reward ratio actually got hit, and this one led to become a new resistance level. But let's take a look look at, let's continue this process. So let's take a look once again. You can see here, we had selling pressure coming in multiple times. We broke that one, right? We broke the resistance. We flipped the resistance to become support. So here we have yet another signal. You can see these two candles together. We have a strong green momentum candle coming in right here. And this green candle together with the red one is also a bullish engulfing pattern. So this was yet another entry point. We enter at the candle close of this candle, and if you wonder where do we set our stop loss, well, we need to be flexible here. Depending on how the market look and market structure, our stop loss will depend a bit. So you could say, wouldn't you set your stop loss below the lowest point of the green candle? Well, in this case, since the previous candle is a bit lower here, I would actually personally in this case set the stop loss using the other method to set my stop loss, and set the stop loss below this gray area right here. So we set our stop loss there, and once again, to keep this simple with the risk to reward, I would set us risk to reward ratio of 2 right here, and you can see that this is yet another trade that locked in some nice profits. Once again, we can clearly see we are clearly above the moving average, and the RSI is clearly above 50. So we have all our signals for this one to be yet another successful trade. Once again, we can look out for other trades right here. You can see one could argue that we had some kind of trading opportunity right here, but in this case we didn't have any strong momentum candles coming in at the support, so I would have probably skipped this trade. Even though this would have probably worked, I didn't see a strong enough signal. But you can see that when the price came down here and tested the support once again, you can see that in this case we actually had yet another strong momentum candle. So we can use our long position once again at the candle close of this candle, set our stop loss below the lowest point or below the gray area. Let's set our stop loss below the lowest point of the candle, and once again, using a risk to reward ratio of 2 right here, you can see that unfortunately our trade, we did see this impulsive move up, but we didn't reach our profit target right away. The price started to go sideways, but if you were patient here, you can see that the price eventually hit our profit target right here and locked in some nice profits once again. So in this day trading strategy, the moving average and the RSI indicator were used as tools for confirmation, but understanding the indicators deeply is very important to improve your win rate. So now I highly recommend all of you guys to watch this video about moving averages next.